They come to the assumption of, over here, okay, what are we going to set the interest rate at? What is our money worth, in essence, okay? I'll just briefly talk about this side. We'll leave that side for a minute, come back to this side. Money center banks is the same thing. Either the Treasury or the Fed, okay, can inject money in through the open market operations if they want to sell. If they sell T-bills to a money center bank, and that way they'll buy these as assets. The money center banks. The Treasury does the same thing, basically the same as selling it anywhere on the open market. Because once the money has been injected in the economy through whatever mechanism, or the T-bills have been sold into the market by whatever mechanism, it's now part of the outside economy. The Fed, in its operations between all of its districts and the money center banks, the Federal Reserve central banking system is a closed system. It is entirely closed. It has to, supposedly through its various means, it is to track and keep track of all, and I call these innies and outies. To understand what's going on inflationary or deflationary wise, you need to understand the innies and the outies. Let's take today's, what are they doing today? What did I mean by what I said earlier? It's indeterminate as to what they're actually doing yet. What are they going to do? They're saying that the Fed is going to buy Treasury bills to the tune of $300 billion in order to, what? Increase their assets, because Treasury T-bill is an asset to the Fed. Once they have a T-bill, in turn, they pile up these T-bills. They, in turn, that gives them on their books, on their accounting, the ability to shove more money out into the money center banks through loans, through all the different windows and vehicles that they've set up. Okay? They got to have an asset in order to issue a loan, just like any of the money center banks or the second and third tier banks have to have assets in order to loan against. Assets in commercial banks are known as excess reserves, okay, that are created through deposits that you put into the bank that they have to pay interest on. Again, it's that innie and outie thing. The interest paid in versus the deposit comes in. Any excess above their reserve level, because this is a fractional reserve system, theoretically 10%. They have to keep 10% in order to issue new money. They can issue out 90% of any money that they receive on top of their excess reserves that they have to keep.
Jeff, and then there's markups on that too. I mean, if
sure.
When it's taken as an asset by a money center bank, and they loan it out, that asset out there.
Well, yeah, that's how the whole system feeds out, because as it comes further away from the center, exactly, good point. As it gets to the money side of the second and third, by the time you get it, the interest rate that you see, right now, the interest rate here is 0.25%. And they're looking for a long-term rate to float between 0 and 0.25%. So anyway, by the time it gets out here, you're buying a loan at 4.9, 5 to 5.3, or if you're a higher credit risk, much higher than that. Yes?
Maybe I'm a dummy, but where did the Fed get $300 billion to go and buy treasuries?
It's going to print it out of thin air. When the Treasury notes show up,
Did you say it's there?
There's a magic bit machine right here. Okay, there's a magic bit machine right there, right? That any time a Treasury note that floats in the door, right? They simply note that Treasury note as a line item entry on an accounting system that says, boom, here's authorization to print this amount of money, and gives it back to that bank or the government. Depends on if it's buying off the open market, the T-bill off the open market, or the T-bill off directly from the Treasury.
Can I ask one more?
Sure.
Treasuries all depend on somebody buying them, right? In other words, you keep up at the open market that treasuries are going to go into. So does the whole system depend on people buying treasuries?
No. No, because guess who's the buyer of last resort for all Treasury notes? The Fed. If nobody else buys a single Treasury note, right, that's when we moved to direct monetization. And that was the signal that was sent today. Okay? Maybe. This direct monetization. Because when the Fed starts buying up all the open market notes, if there's a sale hold, or there are auctions being held by the Treasury, or there are open market sales that are going on and nobody's buying those notes, and all of a sudden the confidence in those notes becomes a question, guess what? The Fed runs out and sucks up the difference. And it simply creates the cash, because, see, it's an immediate swap. I have the asset to create the money as soon as I finish the exchange. I have the T-bill. That's an asset. And I've created the money that reflects that asset. Let me get through this a little bit, and then we'll come back to questions.
Can I just comment on that real quick?
Okay.
The signal that this was going to happen was last week when they were talking about China and China's willingness to buy our debt. And China didn't get the answers that they wanted, so now we have to be the buyer of last resort.
And Hillary wasn't that attractive.
Yeah, as soon as the Chinese signaled they're a bit worried, I think was Yen's comment, right? As soon as they signaled they're a bit worried, you know this was not, they've been thinking about it for months, as they said today, but all of a sudden, guess what? It became real important, okay? However, if you notice in the gold price, it sends an extremely mixed signal, because the gold price moved more today in the positive direction than it has, I think, in the last 6 or 7 years, and it moved in about an hour. It moved $60 literally in an hour. And I'm very interested to go home tonight and see what it is doing in the Asian overnight markets, because
Did it break 1,000?
no, it went to just under 950. But based on what the Asian market does tonight, it might break 1,000 before we wake up tomorrow. We'll have to see. I don't know. We'll see what they're going to try and signal here, whether they're buying it, today's announcement, or whether they're not. So in any case, it's like I said, this is, what happened today reminds me of that quote from the movie The Matrix, where Tank, the extraction and injection operator, he says, man, we're living in exciting times, very exciting times. And I think that's exactly, we are living in very exciting times. Okay? Yes?
What are the Chinese going to buy? I mean, is there any way they can receive what was suggested today as something beneficial to them?
No.
Is the Fed going to...
No, when they think about it long enough, no. Okay? But they got to think, they're going to have to think it through, because they're sitting on the knife's edge. Okay? They got 900 billion in Federal Reserve notes. They got almost the same amount in T-bills. They're sitting between,
Bunch of cash.
yeah, I mean, they're sitting between where do we make our moves first? Do we start using the cash to start buying things so we can get physical assets to try and truncate inflation, which if they do to any large degree is going to signal to the rest of the world they have no confidence in the dollar. Boom, everything's going to go up in price overnight, especially first the commodities market. Second, they start selling T-bills to get cash. Well, what does that do to them? Well, it starts monetizing the debt, unless they're selling them back to the Fed, which is the key issue, right? Then that's deflationary. But and only if the Fed's buying them does that get everybody out of a jam, because it's taking cash out of theirs, it's taking cash out of the system for them. So we'd have to, like I said, it's going to be how all this works out. But that's if they're going to go on the open market. And that's the same thing with today's announcement. If they take those T-bills and they directly monetize by selling them from the Treasury instead of on the open market. Remember, if they start getting the Treasuries on the open market, if they start buying up the Treasuries on the open market, that's deflationary. They're sucking money out of the outside system. Yes.
Would you explain the mechanics of that?
Which part?
Of how the Fed buying securities in the open market is deflationary. And by deflationary, I assume you mean a decline in the money supply.
Maybe I said it backward, because I keep moving back and forth between, there's so many different deflationary, inflationary vehicles, the way that they're doing all this stuff.
When the Fed buys securities, it's
Right.
inflationary.
Ultimately, there's only one, but the way that happens sometimes is very indirect or very direct, depend on how you're doing it. Like I said, the previous example was a net neutral because money was being taken out of the system through the purchase of the T-bill, and it only came back in slowly, which is neutral to inflationary, but it's inflationary over a long period of time. This one, yes, that's directly inflationary as well. It's going to hurt their dollar reserves on the other side of the coin.